Hey there, everyone, and welcome to the Final Bar. It's Tuesday, July 30th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. We're in the meat of earnings. We have the Fed meeting today and tomorrow. So tomorrow afternoon, certainly be focused on Fed Chair Powell's comments, latest notes from the Fed governor meetings, and pick through them as much as we can. But for today, it's all about earnings, some economic data out, but earnings really move the needle on a lot of key names. At the top of the list today, you'll find some value, you'll find some defensive sectors, you will not find a lot of growth. With that in mind, let's get to our market recap and focus on how the market's evolved. Today, the S&P 500 finishing down about 0.5% to 5436. The Nasdaq Composite much worse, down about 1.3%, really feeling the pain today relative to the value side of things. The Dow Industrial Average was up about 0.5%. And again, this is a common pattern that we've seen here, certainly in the last couple of weeks, really in the last month. In May and June, coming off of that April low, is kind of growth over everything. And the growthy stuff, the NVIDIAs and Amazons and others really getting it done while value sectors were lagging. July has been a completely different month where you've seen value sectors thrive. You're seeing defensive sectors starting to show signs of strength, particularly on a relative basis. The growthy leadership that had done so well in the first 6 months of the year, really starting Q3, not particularly well. So the Nasdaq down, the Dow up, and that's just, purely driven by, I would argue, the sector allocations, right? So the Nasdaq very technology heavy, communications, consumer names, certainly more internet type of things, and the Dow really is more overweight. While it does have some growthy stuff in there, it's much more of a value tilted index. So as a result, you can see it actually moving higher today by about 200 points. Mid caps and small caps both up as well, and your best performer on this front page is the S&P 600 Small Cap Index, up about 0.6%, continuing to perform quite well here as we get into the third quarter and really get that first month almost closed. Today will be the last day in January. The VIX back higher by about a full VIX point, almost to 18. So the VIX continuing to be fairly elevated. We're not in an extreme correction range where the VIX is over 20, but we're certainly in that pullback range where the VIX is between about 15 and about 20. And again, those aren't hard and fast rules. Those are general levels that I've become accustomed to paying attention to. And I like having sort of a line in the sand approach, right? A VIX below 15 means I should just not be worried about volatility. VIX over 15, while not necessarily giving a particular path that the market is probably following, it tells me there's elevated risk of uncertainty and certainly elevated risk of downside, of a drawdown for the S&P. And that's where we remain here today with the VIX popping higher, almost a full point. Interest rates overall continuing to trend lower. The 10-year yield is currently around 4.14. The 30-year long bond yield is around 4.4%. Of course, the short end of the curve is still higher, still above 5%. Now, that is where the Fed, potentially starts lowering rates. Again, general expectation according to the futures market is almost minimal to zero chance of a change in Fed policy tomorrow at this July meeting. However, very real possibility, and the market is actually pricing in an almost incredible likelihood that the first rate cut comes at the September meeting. It's about 6 weeks away from tomorrow. So for now, rates overall are trending lower, and again, that's one of those things sort of propelling small caps higher. Certainly a good setup for small cap stocks. Bond prices moving slightly higher. The dollar index, no real change from yesterday. And I think that's important, right? Because the dollar, I would argue, the dollar spiking up here is probably a sign of very defensive positioning, probably a sign of a corrective move starting to accelerate. The dollar staying low like this or not really popping higher tells me that this is still more of a rotational play, right? A lot of value stocks actually look quite good. There are plenty of stocks actually breaking out this week. It's just not the growth stuff, and it's not the mega cap names that are such big weights in the benchmark. So if they're struggling, which they are, the benchmarks are almost going to look artificially weak relative to the strength in individual names. You can see that by how the Nasdaq is down this week, but breadth conditions overall are quite robust, as we'll get to here in a moment. Just to round out our discussion of the major asset classes, commodities lower. The DBC was down about 1/3%, but gold and silver prices both higher. Gold was up about 1%, silver prices over 1.5%. Crude oil slightly lower, and so that's weighing on certain areas of the market for sure. Bitcoin, we talked yesterday about that test of 70,000 again, almost to the penny before the U.S. market opened yesterday. Today, we sort of stalled out around 66.5 to 67,000. Overall, we trended lower through the course of the equity trading session. We actually popped higher in the last hour, getting up to around 66,000, but that's down from yesterday's close, and Ether price is down about 1.6% as well. Let's look at the 11 S&P sectors here on our dashboard. You can see that energy, despite the USO, the crude oil price actually going slightly lower, energy prices up about 1.6%. Some key energy names reporting later this week. There might have been some today. Yeah, BP reported before the open, if I'm reading this right. During earnings season, my planner is a sketch pad of a nightmarish sketch pad of tickers on certain days, and just trying to think about which names are most important at different times. But end of this week, you have Exxon and Chevron both on Friday, and there's some other energy stocks reporting through the course of this week. So, earnings certainly are going to be a focus. If you have sector allocations, you have sector bets on at the moment, or if you have big individual positions, this is the time to certainly be focused on earnings. Financials, number 2, up 1.1%. Real estate and utilities both up as well, and that's third and fourth for the day. Only 4 of the 11 S&P sectors down. Technology, your worst performer, it was down big. Tech down 2.5% today for the XLK. Big names like NVIDIA and others really getting dinged. NVIDIA was down about another 5% today. Consumer staples down 0.2%. Consumer discretionary down about 0.6%. Looking down to the Magnificent Seven and Friends, you can see why technology as a sector has struggled a bit, because NVIDIA, one of the biggest weightings up there with Apple and Microsoft, NVIDIA down, it really accelerated into the close. I thought that might be going on here as I checked it a little bit before we started the recording here. It's down about 7% today. That's another tough move. And what's interesting is those names like AMD and NVIDIA and others have been now just trending down fairly consistently here in the month of July. The longer term trend is still fine, right? We're still making higher highs, and even with this pullback, most of those charts are currently showing a higher low, but that shows you what an uptrend that they've experienced. And on the way up, how many of us talked about how things felt overextended, how it felt like we were leaning too far over our skis, how it felt like these are getting way above moving average support, and sure enough, they're all kind of coming down. The timing of that pullback can be very difficult to time, but the reality of how much these stocks had run and how much they stand to decline after a run like that, I think we're seeing the evidence of why that is something we often look for when stocks are accelerating to the upside. Tesla down another 4% today. It's after bouncing higher yesterday. Yesterday we gapped up. Today actually pushing right back down to that 220 level. If you look at the little preview chart, you can see how we pulled right back to that similar kind of level earlier. Actually last week is where we were looking at there. All right, let's go to a daily chart of the S&P 500. We'll continue here through some of the key charts to watch. So yesterday and the day before, Monday and Friday, we're kind of sitting on this 50-day moving average. What's happened the last couple days, right? So last Wednesday, we traded down to the 50-day. Thursday, we opened right at it and closed below it. We didn't get a downside confirmation. Friday, and then Monday, we actually closed above the 50-day. Today, we closed slightly below the 50-day moving average for the S&P 500. So basically, we remain in this sort of limbo, having broken that initial level, that trend line we've been talking about for months now, but we have not broken below 5,400, although we traded down to it again today, but the market bounced off going into the close. We're back below the 50-day moving average. I continue to think of 5,400 as the level. That's the line in the sand for me. We hold that, and things just aren't getting that bad. We break that, which could happen as early as tomorrow for sure. Things could get very dicey very, very quickly. The RSI, again, holding just above 40. That's kind of still okay in a bullish scenario. RSI starts breaking below 40, while it doesn't guarantee we're in a new bearish phase, certainly opens up that possibility and certainly would cause me to think about downside objectives and really what it ends up meaning if the market keeps going lower. Right? You think about what if the S&P goes down to 5,200, down to 5,000, down to 4,700. All of those are possibilities here in the next month or two. How much of that downside are you willing to participate in? If you're a long-term enough investor, maybe you're fine with that kind of drawdown. If you're more tactical, more short-term, that could be completely untenable. So the question, the right answer is really something you have to answer, which is how you try to play that move and just think about those future paths and what sort of bets you'd be willing to make. I would certainly say, given what I've seen so far, at least starting to get defensive, thinking about downside protection and thinking about how you might implement that if you're not doing it already, I would say no better time than right about now to be having those sorts of thoughts. Have a game plan in mind. Don't just wait for a big down day to start to think about what being defensive or what raising cash or what hedging might look like for you to try to manage potential market downside, because the risk of it certainly seems very real right about now. Let's look at a couple of breadth indicators. I mean, it's so interesting as we see the markets in a vulnerable place. We see the S&P 500 pulling back. Look at how the cumulative advanced decline lines are all actually very close to making new all-time highs this week. That is sort of the weird contradiction we find ourselves in. This is a market that at times has rallied on weaker breadth, right? Particularly in May into June, right? From mid-May to the end of June, the S&P is going higher and breadth is all going lower. Now, that's usually a warning sign for me because it tells you the market's expanding, but with less participation. That's because the mega cap stocks were doing so incredibly well. Now we have the opposite, where the mega cap stocks are struggling. A lot of other things are working really well. So while the S&P is down, it's not because everything's down. It's just because the big growthy stuff is down. The rest of things are actually quite good. So I'm not struggling to find stocks that have constructive technical patterns. It's actually remarkably easy to find them right about now, which tells me this is more about a rotation, at least for now. Also worth noting, even with the S&P coming down, 78% of the S&P is above, S&P members that is, are above their 200-day moving average, and that's up from 65% just a couple weeks ago. A couple weeks ago, we were less than 50% of the S&P above their 50-day moving average. That was around the 4th of July holiday. Now at the end of July, it's around 70%. So about a quarter of the S&P were below the 50-day and now have gone back above it, while the S&P is struggling to hold it. So again, it's about rotation for now. I think the danger is the mega cap weakness starts to drag other things down and investors go full risk off. That's where I would start to be concerned, but I'm not seeing that necessarily just yet, which is why I keep describing this as rotational. Now, the VIX is certainly in pullback range between 15 and 20. A VIX above 20 for me just tells me to start really thinking about further downside scenarios. So last time we popped above 20 was here in October of 23. Ended up being a pretty decent low. And that's what I'm saying. It's just because a push above 20 doesn't mean the VIX is going to go to 40 and that we're going to retrace the entire previous bull market. But that has happened, and that's why when we get above a VIX of 20, all of a sudden we're in a relatively small number of observations, which happens to include every major correction going back probably in modern history. So, recognizing those levels as a potential sign that things could get worse, and just thinking about how you want to manage, again, just think about how you want to allocate, given that possibility, I think is important. So we certainly could be getting there. I want to look briefly at the Nasdaq 100 just because, again, it's diverging quite a bit from the value stocks and certainly from, in some ways from the S&P, but not so much. I mean, the Nasdaq 100 and the S&P 500 actually look remarkably similar right now. The Nasdaq 100, though, I would argue, has decisively broken down through its 50-day moving average. I think a similar trend line taking the October 23 and April 24 lows has been broken decisively. So overall, the Nasdaq 100 certainly much more in a weaker position than we see with the S&P 500. The weekly chart of the Nasdaq 100, I think, though, is fascinating. Here's the low from the end of 2022. You line that up with the October 23 low and the April 24 low. You can see that lines up basically with where we're at right now as we record the show after the close on Tuesday, July 30th. So I would say the weekly chart of the Nasdaq very close to breaking down through key trendline support And again, for me, would start to tell me, real risk of further deterioration. Think about the great buy signals you get when you have a clear trend line going down and you finally get a break above trend line resistance. That often indicates a change of character from a bearish 2022 to a bullish 2023. Are we about to get that similar kind of signal from the Nasdaq 100, which has been in a primary uptrend for the last 18 months? And all of a sudden breaks through a key trend line on the weekly chart. I think that's a danger here going into August, which in an election year is usually a pretty good month. But on average, if you look back through market history, August is actually pretty weak, including September even worse. Now, I do want to highlight again another way to think about the sector rotations, and I showed this on a recent episode, so I'll pop it on here again. But on my Mindful Investor live chart list, I have this set of charts, and one of them would be looking at value sectors on a relative basis. Look at how the month of July has been remarkably strong for things like energy, industrials, and financials. Here are your three defensive sectors: utilities, consumer staples, and real estate, all trending higher here over the last couple of weeks. And you compare those two to the relative performance of your three growthy sectors, and technology is really standing out as really deteriorating here in a different way, right? Communication services has been in a bit of a downtrend here for the last quarter. Consumer discretionary certainly has actually been starting to improve over the last 6 weeks. Technology was the biggest gainer, and this is the AI trade, this is the semiconductor trade, the dominance of that theme, and now we're starting to see again a big, I think we're past starting to see, we're definitely seeing that rotation away from those sectors. Let's finish off here talking about some individual stocks. A lot of earnings to digest. I actually want to start with a company that did not report earnings today. They actually reported last week, but have what we call a gap and run pattern that I wanted to highlight for you. It's Molina Healthcare, ticker MOH. What's interesting is about a week and a half ago, this chart couldn't have looked much worse. I mean, it's in a primary downtrend. The momentum is weak. It's underperforming. We're getting near to that 2023 low, but not in a way I would feel particularly good about. This feels all about unwinding the big gains that you saw from early 23 to early 24. It's like all of that just getting picked apart month over month. But last week, positive earnings surprise, gaps higher, and then continuing to run. And that's, I call that just a gap and run pattern where you gap higher. The question after a big gap higher, particularly a name like this has been going down for so long, when you have a gap like this, are all these investors that bought back here just so thrilled to at least get back to that level that they sell out and are just thrilled to cash out and go find something else. They don't have to worry about Molina Healthcare anymore. That's not what happened. After the gap, you see additional buying power coming in because the price continues to go higher. Even today, it's up over another 5%, getting close to regaining that 200-day moving average. I like what I see of the performance post-gap on the chart of MOH. It makes me think that healthcare is one of those interesting sectors. It's got some offense and some defense all kind of mixed into one, but some interesting charts coming out of that sector for sure. In the industrial sector, we'll look at some names that reported here in the last 24 hours. HWM, I think was yesterday. Might have been actually, I think it was this morning before the open. HWM reported. I'm sorry I don't have that in front of me. Yeah, it reported today. You can see the gap higher. It's up about 13% today. What's interesting about HWM, this has been a name we've talked about in a group called the Diversified Industrials. It was part of that sort of aerospace defense type of category. And some of these stocks have just been on incredible runs now for over 6 to 12 months, even further. HWM has been a fantastic chart for multiple years now. Today's gap higher reminds me a lot of what we experienced back here in April. Look how similar these periods were. We make a new all-time high. We pull back for about 6 weeks to an ascending 50-day moving average. We briefly undercut it. We trade back above it slightly and then have a big gap on earnings, and we continue to trade higher. That was the last earnings report. We gapped up. We had a nice run for about 3 or 4 more weeks, continuing to push to new all-time highs. I'm wondering if we get a similar pattern right about now. I'd keep an eye on the momentum, because the momentum, particularly on these big moves to new highs, has been really helpful when we come out of that overbought region. That tells you that primary move, that big thrust higher, is probably starting to dissipate, at least the momentum. So keep an eye on HWM, and particularly the RSI, I would, in this environment. F5 is another one reported yesterday after the close. You can see the gap higher here today, up about 13%, closing above $200 a share, which is impressive to me because it's getting above that high from the first quarter. So now the question is, do we hold it? We talked about Molina Healthcare gapping and then running higher. Do we get a similar thing for F5? I think holding that 195 level, which would be the resistance from March and April, really key from a technical perspective on F5. Otherwise, you have to start look back in that gap range to find potential areas of support. PayPal was before the open today. This is one actually gapping higher as well, up almost 9% today. It did get up to $65 before trading down around $64. You know, what I like about this chart is the fact that it's now bounced off of support, made a bit of a double bottom pattern here around $57, and now has gapped higher above the most recent swing high. The problem is there's still overhead resistance in a big way from around $67 to $69. That's sort of these levels back here. For most of 2024, we've been unable to get above around 67, 68. My question, do we get above there? If we're able to break above there, all of a sudden the weekly chart would demonstrate a big rotation from a distribution phase really through the end of almost the end of 2023, this consolidation phase we've been in for most of 2024, getting above 70, I would say, really would complete that rotation to more of an accumulation phase. That's a big if. I think that's a big ask for PayPal after the big move here. Some things that actually got beat on the downside here. We'll go back to the daily chart and talk about Merck, talk about Molina Healthcare. This is the same sector, but MRK, instead of having a nice earnings release and popping to the upside, the opposite, right? We actually gap lower. We closed below the 200-day moving average for the first time since the end of 2023. What I'm concerned about here is we're now below this range that we've been in year to date. So like PayPal, we talked about, can it break higher? This is kind of like a PayPal that actually broke down, had a well-established base, but instead of breaking out above 135, it's now breaking down below 120. The question you have after a day like this is what happens tomorrow, right? What's that follow through? Do you get another close below the 200-day moving average, which now in my mind is the level you just want to get above if you're looking at Merck. NVIDIA certainly gapping lower today. NVIDIA not an earnings name, but part of the technology complex really getting pushed to the downside today. There's no real change to this trend. I would say the trend since mid-June and this remarkably important bearish engulfing pattern followed by another really good bearish engulfing pattern here second week in July. It's been a clear downtrend. So a 7% drop certainly doesn't feel good, but this is the latest in a big move to the downside. NVIDIA just managing to give up a lot of the gains that we registered in the first half of 2024. Still up on the year, and that just shows you how much of a rise it had going into this recent high. The inspect tool on Stockcharts, by the way, I absolutely love because you can click on a high like that and just drag down. And over there, you can see the, I dragged the wrong way. Sorry, you click and drag down. I dragged the wrong way. Drag down to the left. You can see on the left side of my chart, 26% drop from that peak that we had in mid-June to where we closed today. I mean, that hurts, and that's, by most market vernacular, you'd call that in a correction if we're down at least 20%. What we looked at earlier in this week is the fact that NVIDIA looks a lot like it did in April before a nice bounce higher. Now it's starting to look less and less like April and more like a deterioration. I think valid break below the 50-day moving average. I'm looking down to that April low. I'm looking down to the 200-day moving average. That's around $80 a share. That's another 20% loss above what we've already experienced. I think that's a possibility, certainly from a technical perspective. Between now and then, the question is, do you see any signs of stability? Do you see any signs of accumulation? Sign that buyers are coming in. One of the indicators I love to throw on a chart like this is the MACD or the PPO. Right now it's in a clear sell signal. You can see back here in April, we had that buy signal at the end of April, beginning of May, telling us that the downtrend pullback phase was probably over. We have a similar sort of environment here. I'm happy being patient and waiting to see when it breaks back above and gives a buy signal. Didn't happen today, so it tells me to be patient. Qualcomm's another one, just dinged today, down about 6.5%. Other semiconductors pushing lower as well. This one, again, finding spores, kind of what I'm thinking with NVIDIA. You get back to the April low and the 200-day moving average for Qualcomm. That's around 155 to 160. We're getting very, very close to that range where I might expect a very real opportunity for a bounce off of support. But for now, again, these charts are in distribution mode. On the tactical time frame, lower lows, lower highs, not a good thing. Three things I'm watching today after the close, and we'll look and see how they're trading in the aftermarket. As a reminder, the aftermarket is usually pretty noisy, so I would say, wait to see how things trade tomorrow. But these are three companies actually reporting after the close today. You can see AMD actually bouncing higher, about 6% after the close. After hours is trading around 147. You can see we recently traded below the 200-day moving average, similar to Qualcomm. Nice earnings beat today. I'm wondering if that boosts the semiconductor space tomorrow. NVIDIA shareholders and Qualcomm shareholders and others, I'm sure, would love to see that. We'll see if AMD, again, after hours reaction can be noisy as we digest the earnings report, as there's an earnings call. A lot of things can happen, but for now, actually moving higher in the aftermarket. Microsoft, obviously another big technology name, reporting after the close. It's down about another 5% in the aftermarket. It's actually down all the way down here, right at the 200-day moving average. It appears after the announcement today after the close. We'll see how things open tomorrow, but for now, aftermarket trading pretty weak. Starbucks is another one for now, up about 2% in the aftermarket. Looks like we're testing the 50-day moving average from below after today's report. It's up about 1% today. That's another one with an interesting one to think about. Caesars is also an interesting one because both Starbucks and Caesars, bouncing off of support here in the last week, and I'm wondering if earnings can be the next catalyst to propel these stocks higher. I'd love to see something like CZR get above 40, which would be above the July peak, get above the 200-day moving average. Why not? Folks, that's a wrap for today. So many things to talk about with earnings, with the Fed coming up this week. We're here to help you along the way. Stockcharts is such a great platform to help you navigate these uncharted waters, pun intended. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.